Now, if you're in the process of trying to purchase a home or potentially getting close to that process and want to start thinking through some of the particulars, one of the questions that undoubtedly comes up is how much of a home can I afford? And this is a very important question to answer. And so what we're going to do in this video is walk through some tools that you can use to get a little bit more clarity over how much of a home you can afford. And so we're still going to purchase this nice, beautiful home with green grass over here with a somewhat weird aesthetic. And so I'm going to give you a couple of tools to be able to figure out if we can purchase this home. So the first thing to figure out is there are a number of variables that influence ultimately what you pay, right? So the amount that you're borrowing affects what you pay every month. The interest rate to which you borrow it affects what you pay every month. How quickly or how slowly you pay off the loan affects obviously your monthly payment, and all those sorts of areas. And then obviously your credit affects your interest rate and those sorts of things. And so I'm going to introduce you to a couple of different ratios. The first one is what we call a front-end ratio. And the second is what we call a back-end ratio. And these can be really helpful tools for trying to help us figure out roughly how much money we should be paying every month towards a mortgage. So let's first start with the front-end ratio. Now, to begin, I'm going to give us a couple of different variables. The first thing we're going to figure out is that what our monthly income is. And so that's the first thing that we need. And so we're going to say, for this example, we make $75,000 a year. So this is annual. So translated into monthly, this is going to be $6,250. And that's what we take home every single month. Now, one important thing is that this is what we call gross monthly income. And so this is prior to any taxes being taken out. That's an important distinction. This isn't what we get in our take-home pay necessarily, but what we actually receive, and then we have taxes adjusted and those sorts of things. So a front-end ratio essentially is a ratio that helps us compare what we call our PITI versus our gross monthly income. And I'll explain what PITI stands for in just a moment. So PITI is an acronym that includes four things. The first thing it includes is principal, interest, property taxes, and homeowners insurance. So sometimes these amounts are included in your mortgage. If you have an impound account, a portion of your mortgage is going to be directed towards saving for those things. If you don't, you have to save for them separately and pay them on your own directly to whoever is providing you with those services. So either your local county or a homeowner's insurance company of some kind. So for the front-end ratio, what we want to do is we want to figure out how much of our money is going towards this particular mortgage. And so typically, you want a front-end ratio between 25% to 29%. That's usually what is considered to be reasonable. As you get higher than that, that could cause some undesirable effects on your monthly budget. So what we can do here to figure this out is we can take our monthly income, which is the $6,250, and we can multiply it by the front-end ratio. And so let's use the conservative figure, which is 0.25. And what that would give us is we would be able to spend $1,562.50 per month towards our monthly mortgage. Now, one thing I want to point out is that this figure is gross, which means this is not our take-home pay. Personally, I tend to be more conservative with regards to personal finance. So I always opt for 25% of take-home pay versus gross, because with the gross amount, it includes money that you're not going to have access to, and so that's not going to help you pay your mortgage. And so I tend to go off of take-home pay versus gross for that very reason, and it just makes that your finances are so much more conservative and you don't have any problems making your monthly payment, especially if undue expenses come up. It's just a more conservative figure. So this means that we can go ahead and afford a $1,562.50 monthly mortgage payment. Now, this might be reasonable or not, depending upon what you're looking at. And so if you're looking at homes that would require you to get a mortgage of $2,000 or plus, then that might not be reasonable considering what your expenses are. So this is a great way as a starting point to figure out what your monthly payment should be roughly. Now, in terms of how much of a house you can purchase, you need to factor in what your down payment can be. And there are a number of really good financial calculators online, either through Zillow or Redfin, that can help you figure out in total, like what can be the purchase price of your home. We're focusing on, well, what can we pay on a monthly basis? The other thing I would consider is a 15 versus a 30-year mortgage. Obviously, a 30-year mortgage, your monthly payment would be less, although you're paying a significantly higher amount of interest over the life of the loan. So when it's doable, I always encourage people to get a 15-year mortgage when it's financially feasible. So let's add another component to this, because one thing that we're not considering is we're not considering our other debts. And so a back-end ratio we're going to use basically is what we call a debt to income ratio. Because the 25% might be reasonable, but what if we have a lot of other outstanding debts that, of course, our money is going towards? So for a debt to income ratio, most financial advisors would not recommend exceeding 36% in your debt to income ratio. And so I'm going to walk through how to calculate this. It's very simple. We're still going to take our $6,250, multiply it by 0.36, and that's going to get us $2,250. So in this example, our monthly debt payments, which include what we pay for our mortgage, our property interest, taxes, and insurance, and includes any other consumer debt, should not exceed $2,250. So as an example, let's say that we still have our mortgage, which is the $1,562.50. And we also have a $500 a month car payment. And we also pay about $300 per month on credit card debt. If we add up all these figures, our monthly debt payments, including our mortgage, would be $2,362.50. Now, if you divide that by 6,250, you would get a debt-to-income ratio, or a back-end ratio, whichever terminology you want to use, of 37.8%, definitely exceeding our 36% that is recommended. And so as a result of this, this shows us that if we were to fund this mortgage, giving our existing debts, then we may be put in a position to where we are a little bit more strapped financially and have less financial flexibility than we would otherwise. In which case, your thought process might go down the road of, well, maybe I can work on taking care of some of these debts. And so if we take care of the vehicle, that's $500 freed up, and that certainly makes it so this is now a lot more feasible. We can also look for opportunities to increase our income, which is great. And then we can also do the obvious thing, which we can purchase a cheaper home, or a home that's more in line with our budget. And although that's hard to do and accept the realities of our finances, it really helps to put us in a better financial position, so that when we purchase the home, it is more of a financial blessing versus an actual curse, and then we run into financial difficulties. So that's a little bit about some of the thought process to analyze what you should be paying on your home. Again, there's a number of different variables to consider, and I always encourage people to use some of the really good calculators that are available online, whether it's through Zillow and Redfin, to help you better estimate the total purchase price. That'll help you do a little bit of shopping.